Hi all, we're getting into the final stretch of the semester and we only have really two more sections ahead of us. In this section, we're going to introduce the concept of open economies and the macroeconomics of these open economies. So up to this point, we've really focused on closed economies, right? And a closed economy was an economy without trade, where a country was basically entirely reliant on its internal investment, internal consumption, and internal government spending. However, what happens when you introduce trade? Well, what we're going to find is that some of the topics we've already talked about, like the monetary system and the financial institutions, ultimately are affected by these open market transactions. So let's look at some of these questions and hop right into it. So chapter 18 in your text is open economy microeconomics, or the basic concepts. So how do we understand open economies? Well, basically, with open economies, we're talking about the international flows of goods and capital. And we have open versus closed economy. So like we said, a closed economy or autarky is an economy that does not interact with other economies in the world. In contrast, an open economy is an economy that interacts freely with other economies around the world. Now, this means that goods are flowing in between nations, and we go to our exports, imports, and net exports. And a reminder here that exports, these are the goods and services produced domestically and sold abroad. So for example, American agriculture is a export of the United States. So the wheat produced in Kansas and then sold abroad in Russia, that is an export. And meanwhile, imports are goods and services that are produced abroad and sold domestically. And so when you go and you see a BMW driving down the road or a Volvo, those are foreign automotives typically produced overseas and shipped into the United States. Now, net exports, then this is simply the value of a nation's exports minus the value of its imports, also called the trade balance. Now, a simple equation for this is that NX equals trade balance, and that is exports minus imports. So if your exports minus imports is greater than zero, you're running a trade surplus. You're exporting more than you are importing. Related, if you have exports less than imports, you are running a trade deficit. This is typically what the United States operates under. And if you are balanced trade, this means that your exports minus your imports equals zero, or everything is in balance. So, if we look at the international flow of goods and capital, particularly focusing on the US economy, what we find is there's a few factors that influence it. The first, of course, are of consumers for domestic goods and foreign goods. Just to give you an example, Japanese car companies took off in the late 70s, early 80s in the United States when American cars grew and deteriorated in quality, largely because of a oil crisis over the course of the 70s. So Americans made big cars that just consumed a ton of gas. And when the oil crisis hit, Americans had a huge shift in their taste and preferences towards cars that were reliable and could also go get more miles per gallon. Japanese cars filled the niche for this, and so Americans shifted towards purchasing more Hondas, Nissans, um, Datsun, which that was originally what Nissan was called back then, etc. So the prices of goods at home and abroad are another influencing factor. If a foreign country can make something for cheaper than domestically, this incentivizes people to purchase abroad. Another aspect of this, though, is the exchange rate at which people can use domestic currency to buy foreign currencies. If your currency has a strong exchange rate, that means that you are able to buy more of another country's currency with your currency. So if the US has a strong exchange rate with the yen, that means $1 can purchase more yen. And what that means is ultimately you're able to consume more at a cheaper rate of Japanese goods because the dollar is stronger against the yen. The next aspect of this, though, is the income of consumers at home and abroad. We expect that if the income of a country is increasing, its demand for exports or for imports will increase. Also, the cost of transporting goods from country to country is another important question here. If it's very, very, very expensive to move goods from one country to another, it makes sense that it would be very difficult then in order to, excuse me, it'd be very difficult then in order to export significant amount to either country. So, but with lower costs, we find that countries trade more and there are more exports and imports between the two of them. To give you an example, the United States' two largest trading partners are Mexico and Canada. Why? Well, they're the closest countries to the United States. Very low transportation costs. And finally, the other aspect of this is government policies toward international trade. If the country adopts a much more friendly attitude toward trades, we expect to have a higher volume of exports and imports. So what does this look like for the US economy? If we zoom over here to our graph on the right, what we see is that imports and exports were largely in balance in the United States until the 1980s. And then the US adopted several free trade policies. And at this point, exports dipped at first while imports grew before reconverging to grow. And since then, there has been a distinguished amount between exports and imports, with the United States typically and traditionally running a trade deficit since 1980. But because we also have goods flowing, that also means we have the flow of financial resources, and we call this net capital outflow. So what net capital outflow is the purchase of foreign assets by domestic residents minus the purchase of domestic assets by foreigners. Sometimes we call this foreign portfolio investment. So basically, when an American firm decides to buy a Japanese bond or when they decide to buy Japanese, then they are having a net capital outflow of money towards Japanese goods. Similarly, when a Japanese company buys a US firm stock or buys a US bond or buys US dollars, it similarly is then a purchase of domestic assets by foreigners. So the way we calculate this is simple enough. Net capital outflow simply equals the purchase of foreign assets by domestic residents, i.e. American spending on foreign countries' bonds, stocks, and currency, minus the purchase of American assets by foreigners. In this case, American bonds, stocks, dollars purchased by foreigners. The important variables influencing net capital outflow are as follows. The real interest rates paid on foreign assets. If interest rates are higher for a foreign asset, this incentivizes domestic citizens to purchase more of foreign assets, which would reduce the net capital outflow. Similarly, the real interest rates paid on domestic assets. If the real interest rates paid on domestic assets is also higher than foreign nations, then this similarly encourages individuals to not purchase as many foreign assets and encourages foreigners to purchase more domestic assets. There again, reducing net capital outflow. The perceived economic and political risk of holding assets abroad. If you think a country is at risk of political upheaval, then it makes sense, right, that you wouldn't necessarily want to put all your eggs in one basket and put your cash over there. So you might sell those assets and try to return them to a domestic situation. So this is something that would reduce net capital outflow. However, if a country is very stable and growing healthily, then this might encourage net capital outflow by encouraging citizens to purchase that country's assets with the hopes of a higher return. And finally, the government policies that affect foreign ownership of domestic assets. For example, China has a law that you cannot own China's currency. So instead, foreign financial markets actually operate with like a proxy currency of the Chinese yen. Meanwhile, the United States is quite liberal. If you operate in the US, you get US dollars, you can repatriate that money to your home country if you wish. So the policies which nations adopt ultimately influence the ability of cash and bonds and stocks to move in and out of countries. So, what does this lead us to? Well, fascinatingly enough, the net exports and net capital outflows must be equivalent. And the reason why is this is an identity, because every transaction of net exports equals net capital outflow. So, why does it work this way? Simply put, let's consider an example. Every time an American firm sells an item to a Japanese firm, that increases exports, and they're paid in yen. The American firm then has the following options. They can hold the yen in savings, which amounts to Americans purchasing yen and increasing net capital outflow. They can purchase Japanese stocks and bonds, which again amounts to an increase in net capital outflow. They can purchase a Japanese good, which instead increases imports, which then cancels out the exports the American firm just sold. Or they can purchase US dollars back with yen, which cycles us back through the first three options for the agency you purchased US dollars from. So, for example, let's say that General Electric sells some electric motors in Japan. They're paid in yen. If they hold on to yen, well, that amounts to a domestic firm purchasing a foreign asset. If they decide to purchase Japanese stocks and bonds, well, that again is just an American firm using its purchase of yen to purchase Japanese stocks and bonds. If they purchase a Japanese good, meanwhile, that just means that they've canceled out their own export, right? So General Electric sold an electric motor, but then they purchased a Japanese good, whatever that may be, and those two cancel out. But if they purchase US dollars back with yen, so let's say they take their yen and they go to let's pick Chase Bank and say, hey, we want to purchase dollars back with our yen. Well, this now means that Chase has a bunch of yen and they go through the same options. Do they want to hold the yen in savings? Do they want to purchase Japanese stocks and bonds? Or do they want to purchase a Japanese good? So this cycle explains why net capital outflow must equal net exports. Now, when a nation is running a trade surplus, it is selling more goods and services to foreigners than it is buying from them. What is it doing with the foreign currency it receives from the net sale of goods and services abroad? It must be using it to buy foreign assets. Capital is flowing out of the country. So net exports greater than zero means this should be net capital outflow instead of net exports. Net exports flowing greater than zero means net capital outflow is also greater than zero. The inverse is also true. Countries with trade deficits are financing their imports by selling their capital assets abroad. So, what does this mean for our other aspects of our GDP and our economic modeling? Well, what we can do is we can take this net capital outflow and we can integrate it back into our savings and investment models. So if we remember that y equals c plus I plus g plus nx equals our GDP, right? So GDP equals consumption plus investment plus government spending plus net exports. We recall that we wrote in our financial chapter, our financial institutions, that you can rewrite savings by solving for I. And in a closed economy, we solved for S by doing Y minus C minus G, because in a closed economy, net exports was zero. However, net exports is not zero in an open economy. In an open economy, net exports is positive or negative. So we can rearrange this equation to be that GDP minus consumption minus government equals investment plus net exports. Then we know that savings must be equal to investment plus net exports. But we can rewrite net exports based upon the identity we had earlier that net exports must equal net capital outflow, NX is NCO, which leaves us that national savings is equal to investment plus net capital outflow. So savings is a combination of domestic investment and net capital outflow, which makes sense because all net capital outflow really is overseas investment. So basically, the national savings rate tells us how much are we saving domestically in the form of investment, plus how much are we saving abroad in the form of net capital outflow. We can sum up this in the following. Notice that table 1 in your textbook has a nice little summary chart table of international flows of goods and capital. So we could see here what's the requirements for a trade deficit. So for a trade deficit, exports are less than imports. Net exports are less than zero. GDP is lower than consumption plus investment plus government spending. Now you might be going, wait, why is this the case? Well, if net exports is less than zero, right, and GDP equals C plus I plus G plus NX, well, if net exports is less than zero, that's negative, which means C plus I plus G plus, or NX, which is negative, means Y has to be lower than just domestic spending. Note that in this example, saving is less than investment and net capital outflow is less than zero. In contrast, balanced trade, we just find that exports equals imports, net exports equals zero. GDP does equal private spending, investment, and government spending. Saving equals investment, and net capital outflow is zero. But in contrast, with a trade surplus, exports are greater than imports. Net exports are greater than zero. GDP is greater than consumption plus investment plus government spending. GDP is greater than consumption plus investment plus government spending. Saving is greater than spent, and net capital outflow is greater than zero. Fascinatingly, if we look over here, we can see the link between saving, investment, and trade in the following table. This is the national saving and domestic investment as a percentage of GDP. This is figure 2 in your text. Notice that domestic investment in the United States is consistently higher than the national savings rate. Why is this? Well, if we look here, net capital outflow provides us some explanation. Net capital outflow is negative in the United States, which means that national savings has to be lower than domestic investment. So, what does this mean for international markets? Well, ultimately, this gets us to the concept of real and nominal exchange rates. So, what is a nominal exchange rate? Nominal exchange rates are the rate at which a person can trade the currency of one country for the currency of another. And appreciation, this means an increase in the value of a currency is measured by the amount of foreign currency it can buy. So, if the US dollar appreciates $1, it now purchases more of another currency. In contrast, depreciation means a decrease in the value of a currency is measured by the amount of a foreign currency it can buy. If the US dollar depreciates, $1 now purchases less of another currency. So real exchange rates then, this is the rate at which a person can trade the goods and services of one country for the goods and services of another. The real exchange rate is a simple equation. It's the nominal exchange rate times domestic price over foreign price. In mathematical notation, you can write as RER for the real exchange rate equals lowercase e, which is the nominal exchange rate, times capital P, which is the domestic price level, divided by P star, which is the foreign price. Now, this leads us to a fun little idea. How can you figure out what the real value of these exchange rates are and whether currencies are adequately valued? Well, we come up with the Big Mac Index. And the Big Mac Index is exactly what it sounds like. It's an index which relies on Big Macs to figure out how much currencies are related to one another. The idea here is quite simply this. If a Big Mac is the same thing no matter where you are in the world and uses the same ingredients no matter where you are in the world, theoretically, then a US dollar in the United States should be able to buy exactly as many Big Macs as it should be able to buy in Sweden. This is the concept at the core of what we will talk about next, purchasing power parity. This is the first theory of exchange rate determination. And purchasing power parity is basically a theory of exchange rates whereby a unit of any given currency should be able to buy the same quantity of goods in all countries. So for example, if I have if $2 can buy me a Coca-Cola, then presumably $2 in the United Kingdom should be able to purchase me a Coca-Cola once I've adjusted for the exchange rate. Now, the basic logic of PPP is as follows. It's the law of one price, and this is the idea that a good must sell for the same price in all locations. The reason we have this assumption is that if prices are unequal, you get arbitrage, which is the simultaneous buying and selling of securities, currency, or commodities in different markets or in derivative forms in order to take advantage of different prices for the same asset. Arbitrage should, in theory, equalize prices then. Because if one area has a good for a higher price than another, presumably what would happen is people would go and purchase all the goods from the lower price area and then sell them in the higher price area, bringing down the price in the higher area and raising the price in the lower price area. So purchasing power refers to the value of money in terms of the quantity of goods it can buy. Purchasing power parity states that a unit of a currency must have the same real value in every country. And as we mentioned, for example, $1 should buy as much of a Coca-Cola in the US as it should in Japan. There's some really interesting implications of purchasing power parity. For one, for purchasing power parity to be the same in two countries, it must be that 1 over the nominal price level domestically equals the exchange rate over the price level in the foreign country. So again, 1 over the domestic price level should be equivalent to the exchange rate over the foreign price. We can rewrite this to say that 1 equals the exchange rate times the domestic price over the foreign price. Rewritten this way, it shows us that the purchasing power of the dollar is always the same at home and abroad, therefore real exchange rate can't change. And finally, we can take this one more step by multiplying the exchange rate over to find that the exchange rate is then equal to the foreign price over the domestic price. So according to the theory of purchasing power parity, the nominal exchange rate between the currencies of two countries must reflect the price level in those countries. There's key implications here. Nominal exchange rates change when price levels change. Therefore, when the central bank prints large quantities of money, that money loses value both in terms of goods and services it can buy and in terms of the amount of other currencies it can buy. Now, there are some limitations on purchasing power parity. Many goods are not easily tradable. Services like haircuts, for example. So there's a fascinating little discussion, right, that Norway is the home of the $100 haircut. Why? Well, because there's a lot of things that factor in the fact that you can't just send an American barber to do a haircut in Norway. And also, there is so many high-paying jobs in Norway. To convince people to take jobs that would not necessarily pay as much, you have to have a compensating wage to encourage it. But then again, even tradable goods are not always perfect. So even if we could have American barbers go and give haircuts in Norway, it doesn't mean they'd be equivalent haircuts. Just give you an example. Americans view German, Japanese, and South Korean cars all very differently than American brands and have different ideas of what their value is. So what does this mean? If we look over at figure 3, we can see an interesting relationship between money, prices, and the nominal exchange rate during the German hyperinflation. Notice that as the money supply dramatically increased, what ultimately happened is the price level then also rose with the money supply. But ultimately, as these two rose, what that meant was that the value of money declined. And if the value of the German mark declined, then ultimately this meant its exchange rate similarly crashed. So basically, if a currency is worthless at home, it's definitely worthless in the foreign exchange market. All right, everyone, that's everything I have for you today. This is our introduction into open economies. And next time, we're going to get into a general macroeconomic theory of the open economy. All right, take care, all.